Hi, my name's Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence based holistic insights to help you master the game of building wealth. Okay, let's start. The first question is from DJ. So, two spouses, 40 and 41, high incomes, but they feel like, that they don't have a lot of surplus cash flow, partly because they've got a relatively large home loan, but also they admit that there's some lifestyle inflation in there. And they made a property mistake, bought an apartment on the North Shore and sold it at a loss. And so to prioritize, they bought a heavy land value asset in Ryde on a sloping block, but spent most of their money on the actual land value in order to try and generate capital growth and, make up for that property mistake, that the apartment, North Shore apartment. But they're finding that, they're spending a lot of money on maintenance. They're not really living where they want to live. So there's some lifestyle compromises in there as well. So to give you a bit of a rundown, family income of 540. So husband 330, wife 210. The home is worth 2.5 to 2.6 with a $1.9 million mortgage. So pretty heavily leveraged there. 630 grand combined super and about 25,000 ETFs outside of super. Two major events that are going to occur to DJ. Inheritance. They're selling a property overseas in a declining market. I'm going to guess that's the UK, maybe. I don't know. Anyway, that market's not doing so well. Anyway, 800 to a million. So that's a pretty significant capital injection. And husband is on track to make partner at a large consulting firm. The capital buy-in will be a firm arranged loan, meaning more debt, but won't drain on their borrowing capacity or cash flow. And there's a bunch of questions that they've got in regards to kind of their strategy. I guess the first kind of observation is the partnership. So what will typically happen, just for those people that out there don't understand what's going on, and it's not always this way, but I'll just talk generally how it is. You buy into the business that you work for. They might say, look, we'll sell you 5%. We'll lend you $2 million to buy that 5% because that's what we think it's worth. And then you borrow that money and you're probably on some sort of repayment schedule. So, you'll get dividends, of course. So, you get your profit share, and the profit share might be, I'm just going to use some random numbers. They won't make much sense, but profit share might be 200,000 and the interest cost on the loan might be 100,000. So from a cash flow perspective, you're better off. Firstly, you've got some interest in the business. So if there's uplift in the value, you get to enjoy or share that uplift. Plus hopefully the profit is rising as well. So you might get 200 grand this year, but hopefully it's 210, 220, 230 in the future. And then as you gradually repay the loan associated with buying into that business, you've got better cash flow. But depending on the repayment terms, sometimes what they do is say, well, you can buy in, we'll lend you the money, but then you've got to put all the dividends towards repaying it. So the cash flow position is unchanged initially, but you're building obviously this asset. In most people's circumstances, you probably wouldn't want to repay the loan because it just depends on what the long-term plan is. But if it's a consulting firm like this, or really any business where you've got working owners in the business, and that's common in that industry, well then for these people, the best thing to do is probably, let's just take the income and only just pay the interest, because they've got non-tax deductible debt personally. So that's where all their cash flow should be going. And actually, if you are confident, and I'm not saying you should be, but if you are confident that the business is going to be worth a lot more in 20 years time, well then if you buy your 5% for $2 million today, hopefully in 10, 20 years, your 5% is worth $4, $5, $6 million. So then you can cash out. What's the point of repaying loan? So I would try and, in these sorts of circumstances, I would try and use as much debt as possible, but it just depends on the type of business and the risk associated with that business as well. I mean, if the business is higher risk, so that is that you're not necessarily have a huge amount of confidence around future profitability and the consistency of profitability, well, then you might want to actually reduce debt. Okay, so just give it a little bit of preamble there. Let's get into the first question from DJ. And the first question relates to their home strategy and landslide risk. Okay, they write, we bought our current home in 24 for its land value to drive growth, but we don't want to develop it ourselves. Given the maintenance strain, our desire for a better location, and medium landslide risk, should our long-term plan be to hold it to at least recoup our stamp duty and transaction costs, or we use upcoming inheritance and partnership to bite the bullet and sell and upgrade? There's a saying, if you find out you're digging yourself a hole, stop digging. So the thing is, the stamp duty is a sunk cost. There's nothing you can do about it now. It's gone. And mathematically, the best decision you should make is what is the best decision today, regardless or irrespective of the stamp duty paid. Because it's a sunk cost, it's gone. You shouldn't let a past decision influence your future decision. Because if you do that, you end up potentially making a bad decision followed by another bad decision, right? What you want to do is start fresh. And the reality is that you're in a different situation now. And this does happen more often than you would expect. So we might have a situation where we meet some clients and they've got a certain income level today. And we go, okay, let's go and buy an investment property. It's an entry grade investment property, but at least it's a start. And then 2 years later, their income might have doubled, because a career change or promotion or whatever. All of a sudden, we look back and go, well, 2 years ago, we should have waited 2 years and bought a much better property. But you can't do that because you just don't know what the future holds. And you really need to make the best decision with the information that you're given. Now the information has changed. And so the decision now is forget about what you paid and what the stamp duty is worth. All you need to do, and this is being as unemotional as possible because our emotion sort of tends to attach ourselves to those past decisions and transactions. But really, as I said, we don't want them to influence today. What is the value of the property I have now? What are its growth prospects in the short, medium, and long term? And now that I've got this insurance and a potential uplift in borrowing capacity and serviceability because of the partnership bump, what could I buy for? And will that get me into a better location? A better location, not only from lifestyle and desires and those sorts, they're okay. Yes, I acknowledge them. But from a financial perspective, does it get me into a location that it's a high quality location, tighter supply, fewer imperfections in the property and the location, fewer compromises, a location that's really benefited from constant excessive demand and finite supply? If the answer is yes, then you should probably do it because we don't know what's going to happen next couple of years, but we do know if we look out over 10 or 20 years and, in say 2046, we look back and go, what was the best decision we could have made in 2026? I'm sure moving to a better location is going to be on that list. And the information I'm missing to really answer this question perfectly, or better, I should say, not perfectly, is the potential uplift or change in income profile as a result of the partnership. So what does that look like? What are the loan repayments associated with a loan? How much is it going to change your sort of position? All these sorts of things. How's the income going to come to you, in terms of, does it come discretionarily through a trust or does it go directly to the husband? Because that's going to change the taxation, those sorts of things. That will help us kind of uncover, but essentially what the focus of the attention would be, together with the partnership bump and the inheritance, can we now afford to get into our perfect location? Now, just a quick word on the landslide risk and sloping blocks. You do your best with the budget that you've been given, and that's all we can do. And if we have a relatively tight budget relative to location that we want to get into, then we're going to have to make some compromises. I think the nuance and the art associated with property-based decisions is to understand when should I compromise in terms of locality and when should I compromise in attributes and property attributes. So I would typically, not always, and this is a generalization, I would probably, depend on the slope, the grade of the slope, but I would probably compromise on a sloping block. That is, I'd probably want to buy a flat block in an adjoining suburb, albeit further out or with less amenity, than a sloping block in a particular location. Now, that depends, right? Because there's some suburbs, for example, in Sydney, where there's a lot of sloping blocks because it's very undulating and, some parts are very undulating and that's normal. So it's got to be what's normal and what's not normal for the area. But that's just something to keep. I don't know the location that DJ is purchasing, so I can't give you, specific, make these comments specific to that location, but we just need to be really careful. And that's why, I talk about using buyer's agents. And look, sometimes people go, wow, it's a lot of money. I can avoid that. I understand. But in some situations, and I'd say many situations where we're spending a lot of money, we really want to understand the nuance because there's some things that we're happy to compromise in some locations. You wouldn't do it in every location, but in some locations that compromise is okay. But in some locations, in the same locations, other compromises won't be acceptable to most buyers out there. And you've got to really understand that nuance. Okay, next question is inheritance allocation. When the overseas property sells, should we dump the 800 to $1 million straight into the offset for peace of mind or look at debt recycling and investing? I think it's linked to question one, whether that $1 million plus the uplift in income is going to get you to your desired property sooner, because if that's the case, well, then you're going to use some of that. I'd probably, you've got 190 in offset. Okay, I didn't. So 1.9 loan with about 200 circa in the offset. That's a pretty decent amount as a cash buffer. You probably don't need much more than that. But what you might do is go, oh, look, I'll put 30% towards debt reduction. So if you've got $1 million, I'll put 300,000 into the loan to reduce the balance, and I'll use 700,000 to contribute towards buying a better, doing the upgrade. But it just depends. I mean, you're better off to use it all for the upgrade if that's what's necessary to make as fewer compromises as possible, which actually, thinking out loud, that's probably the likely result. So look, you're early 40s, so you've got quite a lot of runway, and you're going to get a lot of utility out of upgrading your home over the next 20 years. And notwithstanding, you'll probably enjoy a lot of the financial benefits, the capital growth as well, especially given, there's no capital gains tax. I think homes are starting to become even more attractive when the government's playing around with CGT rates. So that to me seems like the best move. And I understand you're adverse towards debt. I don't know what the income uplift from the partnership will be, but I'll just assume that whilst the debt is large, your income will be significant, and so that the debt is manageable. Actually, there's question number 3 about debt management. Okay, so that's question number 3. How do we balance aggressively paying down our mortgage, taking on a new firm arranged partnership debt, and cash flowing private school fees? Well, I've spoken about the partnership debt. I would be, again, depending on what the business was like, it's how stable its profitability and whether it's expected to grow in the future, those sorts of considerations. But if you were really confident around the consistency of profit and you expected the value to increase, then I wouldn't worry too much about the partnership debt. I think you got bigger fish to fry. So I would sort of quarantine that and say, well, if I decide to change employment, I'll sell out, sell my shares back, and I'll get my money back again. That's your exit strategy. So whether you retire or whether you change jobs, that's your exit strategy out of that debt. You don't need a cash flow exit strategy unless, as I said, you're uncertain around cash flow and profitability and value. Private school fees, cash flowing private school fees, yeah, that's always a challenge, but it'll become less of a challenge if you spend the next few years aggressively repaying debt. I think building assets in addition to your family home are going to be important. So I would do some debt recycling. So aggressively repay your home. If you pay $100,000 off over the next 12 months, establish a investment loan for $100,000 and invest it in ETFs, and use that negative gearing, if you like, to fund that ETF portfolio. Your overall debt doesn't change. It's still 1.9, but the makeup of the debt obviously changes. So at least you're doing two things at once. You're reducing your non-tax deductible debt, but you're also still investing in growth assets. I would certainly consider something along those lines. Fourth question, should we pause all outside ETF investing to strictly preserve our 190,000 in the offset until the inheritance clears? I think 190,000 is pretty good in the offset. Maybe that's going to be almost 12 months worth of living expenses, probably certainly at least 6 months in terms of repayments, all those sorts of things. So I think it's okay. I think I'd keep investing, but I don't think I'd swing for the fences and, invest a lot of that money. I'd be happy. I think 200's about right, and I wouldn't make any changes. Also, I'd wait for the inheritance to come through too before you make any decisions on the assumption that you're going to receive the inheritance. Wait for the property to sell, wait to understand what the amounts will be, wait to ensure that you know when you're actually going to get the cash before you do anything. And the fifth and final question from DJ is, how should we structure the ownership of the purchase of partnership shares? I don't know, because I don't know the situation, how it's going to be structured, what the distribution is going to look like, whether it's dividends or whether it's business income, so whether it's flowing through a unit trust or whether it's coming out of a company in terms of the trading entity. You need to speak to your tax agent about that in terms of getting the right structure. The things that you want to think about are flexibility, so where you're going to distribute that income. That's going to be difficult too, given the proposed changes in the budget, because that could move some of those decisions. So you might even, apparently there's going to be restructure provisions in that law, but we haven't seen them yet. So potentially if the law does change, You can restructure to navigate it, but it's going to be a challenging situation, and it's going to depend on how the business income's coming to you, and also where the debt is and what the business income is relative to the debt. I'd imagine it's going to be positive cash flow, so it's going to produce a taxable profit, and then you just want to work out how best to utilize that profit. But I probably don't have enough. Well, I don't have enough information to answer your question. But good luck with it, DJ. Good luck with all your plans. I think what this question does for me, and I've tried to get this across in previous episodes, what it does for me is it does demonstrate that, property-based decisions interlinked with a lot of other financial decisions, whether they're taxation, whether investing, super, all these sorts of things. And so it's really important that, the advisor has, or most advisors have, a good understanding of property, even if it's just the family home, because it's still part of the long-term strategy, right? That's where a lot of your money and wealth will be accumulated or directed to. And so it's important to understand that. Okay, next question is from an anonymous listener. There's a lot in this email. I'm just trying to work out how to summarize it for you. Anyway, I'll have a go. This person has prioritized building wealth over any lifestyle implications or considerations, but now they want to get to a point where, they would like to start prioritizing lifestyle. They're late 30s, early 40s, 37, 40, so that sort of stage of life. They've got a bunch of different properties, 2, 3, 4, 5 properties worth 7.8 million with about 3.8 million of debt. So, loan to value ratio of less than 50%. So they're in a great position financially for their age. And what they're trying to do is work out, should they build, looks like they've done a subdivision in Brisbane, and they're building on one side of the subdivision. And so what they could do is build their dream home on the other side, the other part of the subdivision, and spend $1.2 million? Or should they maybe sell that vacant land and then go and buy a family home? And they'd like to be in St. Lucia or Indooroopilly, that sort of inner city area. They're both very good suburbs, investment grade suburbs. So, they're certainly moving to a different location. They currently live, well, I don't want to really say where they live at the moment, just in case that's a bit sensitive, because I did want to remain anonymous. But it's in a secondary suburb around about 14 k's from the CBD. So it's not on the outskirts of Brisbane by any stretch of the imagination, but it's not the same as St. Lucia and Indooroopilly. And their home, by the way, is worth 2.2, and they've got $500,000, or actually $455,000 of debt against that. I don't know if that's I think it looks like it's non-tax deductible debt, but it's hard to tell. They might have used the equity in that home, but they've got a lot of equity in that property, is what I'm sort of saying. And they're trying to work out, what should we do? What do we think is the best approach? And really they're looking at two different: sell the vacant land on the subdivision or retain it, and what is the most tax efficient way to upgrade the PPOR, the home. And should we look at delaying the decision while we're close to the primary school, or wait until kids are out of primary school? So the way I would look at this situation is, we've got $7.8 million of property, okay? If we get 7.2% capital growth, it doubles in value every 10 years. I'm not saying you're definitely going to get 7.2%, but if. So in 10 years' time, we're looking at 15.5 million, and then in 20 years' time, we're looking at $30 million in terms of value. Now, I mean, 30 million is a lot of money today. It is, but in 20 years' time, it won't be as much money today because of inflation, but still a significant sum. And let's say if we've been a little too aggressive with that, let's say it's going to be worth, the properties that this person currently holds, 20 to 30 million. Let's just draw a circle around that number. And then he's got $3.8 million of debt against a $20 million portfolio. You don't really care, right? That's manageable. It's fine. It's going to work. So I don't think you need more property now. You've got more than enough property. Like, even if you sold one and you're going to end up with 15 million or whatever, like, it's still okay. You're on the trajectory to generate a lot of wealth. It's now just a case of waiting, letting time do its thing, and waiting for that growth to transpire. So therefore, in order to be in a situation where you can make more lifestyle-based decisions, you don't really want to give rise to a lot of non-tax deductible debt. I mean, you don't want to go and borrow a couple of $1 million. Now, I think that would be too aggressive anyway relative to your income, but I didn't mention incomes, did I? So my partner's on about 200 with some employer shares, about 45,000. The other one's on $230,000 of income. So pretty healthy family income, but the debt's pretty high relative to income too. Certainly over six times income from that perspective. So, you don't want to give rise to too much debt because that's going to really cramp your lifestyle. You're going to have to make some lifestyle compromises. So actually what I would do is I would sell the existing family home. I would do the upgrade. In terms of what to do with the subdivided land, you bought that as an investment. I would treat it as such and work out what you want to do. I think what you probably, so let me finish the home upgrade. So the home's worth 2.2 and you're going to need to buy for about 3.5. Okay, so I've worked it out. 3.5. So that's spending an extra 1.3, which would take your home loan to 1.7 million, which is pretty considerable. So I would sell the vacant land, the lot. You estimate you'll get about 400,000, so it'll take your home loan down to 1.3. Still pretty considerable, but in your situation, I wouldn't worry about debt reduction so much because you've got all this property assets. It's really about the only debt reduction you really need to worry about is getting rid of your home loan. But even then, that should be relatively manageable given your situation, and you've got an exit strategy. It means you've got one of three investment properties that you could sell before the Olympics or after the Olympics, whenever, as a home loan debt repayment strategy. But I wouldn't be too worried about debt because, as I said, if you look at your sort of property assets, and you extrapolate where you might be in 20 years from now, I don't think you're going to be too concerned about debt. In terms of the thesis around selling the family home, it's in a location that is not terrible, but it's inferior to the location that you're looking to get into, St. Lucia and Indooroopilly. And so the way that I would justify selling is I was saying I'm going to take the equity from that property and reinvest it in a high quality asset. And so I'm going to get better after tax returns from doing that because I'm not paying any capital gains tax. And I think that approach is far more attractive today, especially if you think about, the new proposed taxation on CGT. So that's the way I would justify it. Also, it's an undergeared property. So if you kept it as an investment property, what you'll end up having is a lot of debt against your home and not very much debt against the investment property. It's not ideal. So the cost to have more optimal level of debt in terms of split between deductible and non-deductible, and the cost of being able to reinvest in a better asset is the stamp duty. Okay, it's a bit of a hit, but it is what it is. And in the long run, 6 months of capital growth in a market or less sometimes can make up for the stamp duty cost. So I think we've got to be, I'm not saying don't be flagrant about these numbers, but I think we've got to keep it in context. What we're doing here is making a long-term decision. That's what we really should be focusing on all our financial decisions. So, take that long-term lens. And with that long-term lens, stamp duty can easily be made up for or offset just from making one good solid move. So thanks for asking the question, and thanks for the great feedback you gave at the beginning of the question, and thanks for listening. I hope that makes sense to you and a bit of food for thought for other people in that situation looking to do a kind of similar upgrade. Okay, another question from another anonymous listener. So male earns 190, on target to make 300 with bonus income. Female 140. They spend about 100,000 a year. Assets are 300 grand in cash savings, 240,000 in shares. They're mostly employer shares linked to the male's employment. 290,000 in super. Female owns a investment property in Bundaberg, purchased for 630 in 2024, worth now around 840, costing about $8,000 out of pocket per year. And male owns a small investment apartment in Ireland, positively geared, money remains in Ireland. They're weighing up between two options. Should they stretch and buy a 3-bed apartment or perhaps even a small semi-detached house in Sydney's eastern suburbs to get into the market sooner, given the strong long-term growth in this area? Or B, the investment property route, to buy 2 to 3 investment properties. They want to retire at age 60 and be able to afford trips to Ireland, see family, etc. Right, I know this is a stock standard question. However, I feel we're positioned differently given the unique sub-market we're living in with the high growth in the eastern suburbs of Sydney. Okay, so great question. Certainly if the negative gearing changes go through, you buying a home is going to be far more attractive. I'm going to do an episode on it. I've written a couple couple of times about something instead of rent vesting, I've called live vesting, to accumulate most of your wealth in your family home. That's even more attractive these days if they change negative gearing and CGT, and if that change is permanent too, by the way. They're two big ifs. But I think, in terms of apartments, I think Bondi is a very unique situation. So that's where they live at the moment. I might have overlooked to mention that. In terms of apartments, have done really, really well in Bondi. Now, on one hand, you go, yeah, are you getting into a market that's had unusually strong growth? And buyer beware. I mean, it's a little bit like apartments in Melbourne, say going back 13 years ago. They had a really strong period of strong growth, about 8%. So on one hand, you go, is that the right time to get into the market after the last 20 years of I haven't looked at or extrapolated what the growth rate has been in Bondi, but I would expect, or I'd be surprised if it wasn't, 7, 8, 9%. The flip side to that is that, you can understand why Bondi apartments are doing so well. The livability, the lifestyle it offers, and the fact that there's very tight supply. Like, you can't really economically produce a lot more apartments in that area. And, so you can kind of understand it's got its merits. I think I'd definitely lean towards getting the family home. And the reason for that is, well, actually, did I mention that? They're planning to have children in the next 1 or 2 years. So I've mentioned this before, how there's kind of, to do this major lifestyle decision, you can either do it before you have children or once the children are school aged. It's difficult to do it while you're building a family, while you're starting a family, and while the kids aren't in school, because when they're not in school, you've got childcare costs, you've got typically one partner or one parent that's not working, or at least not working full time, and you've got higher expenses. So it's a challenging sort of time of life to build wealth aggressively in for most people. So often the best time to do it is before you start a family, but then you've got to think about, okay, well, if one person's going to be on maternity leave for a little bit, who's going to work, who's not going to work? Do you have enough buffer to get you through? So you need to think about those things, but there's a window of opportunity now. And then once the kids get to school, at least primary school, typically, both parents can go back to work, if not full time, at least working a lot more than what they used to when the kids were younger. And expenses normalise. You get rid of ugly childcare expenses. I mean, everyone talks about private school fees, but childcare can cost more than private schools. And so you sort of get through that period. So if you don't do it now, you might not do it for, another 7, 8, 9 years. And so that's a challenge. Whether I'd buy a so the semi-detached house with a budget of $2 to $3 million, that's what this listener's mentioned. I don't know. I think you might end up making some compromises. The alternate, they said they could stretch and buy a 3-bedroom apartment, but they'll outgrow it eventually. Well, I'd rather spend $2 to $3 million on a 2 to 3 bedroom apartment, because what I'd be looking for is something with uniqueness, and the main uniqueness you want in that area, so Bondi or the suburbs surrounding it, is water views. So if you can find an apartment with water views, so some sort of uniqueness to make sure that, it can't get built out, it's going to maintain those views. If you have a property that has something that's really unique, that's really sought after, you're always going to you'll pay a premium going in, but you'll always get that premium going out. And it gives you a unique selling proposition that is unique to, 80, 90% of the stock that's available in that market. And buying something, not buying the diamond, buying the pink diamond is really the best way to minimize risk, or at least putting it a different way, maximize that you're going to get some really strong capital growth out of it. So I would pursue the apartment purchase, buy an apartment with some unique views, and that's where I'd be focusing on. You say the question's unique because, you're in a situation where the capital growth is quite significant. It's true. I mean, I wouldn't be counselling aggressively go and buy a family home if you lived in the middle of nowhere, but I think it's true that most listeners, that either live on the eastern seaboard or really any of the capital cities in Australia are typically wanting to buy an area where, supply is, finite. And, I looked at it a while ago, I don't know the exact data, but something like 60 or 80% of the population lives in less than 1% of the landmass in Australia. I can't remember, but the whole point, the theme is we're all trying to live in a very small part of Australia. And that's because of lack of infrastructure, living outside of those locations just deteriorates your standard of living, employment opportunities, all these sorts of things. And so that's the uniqueness that Australia has relative to, say, other countries where you've got more even density across the whole country, like you look at the UK or France, for instance. And, so that's why I think for most people, buying their forever home makes a little bit more sense. Okay, I'm going to squeeze one more question in today. I hope you forgive me. This person likes to be called No Idea. So I'll call them No Idea. Okay, I'm 49, my wife's 39, combined income of 815,000, so huge income. We have a $12 million property portfolio with about $6.3 million of equity, so we've got about $6 million of debt, and around $320,000 of rental income, roughly costs about $60,000 a year to hold. My dilemma is capital efficiency. A large portion of our equity sits in a Sydney CBD apartment on a low-yield harbour suburb property. If your goal was to generate roughly $20 to $30 million in net worth in 15 to 16 years, would you prioritise keeping the leveraged property portfolio intact, recycling some equity into ETFs and super, or deleveraging to create higher passive income earlier? How would you structure? Well, No Idea, this is a really easy question to answer because it's all just about maths. The benefit in enjoying strong capital growth is you don't pay tax on it every year, and so you get to reinvest that growth on a pre-tax basis and you delay the tax bill. Whereas if you convert your returns into income, then you're going to pay tax every year and the tax drag is just stronger. So that's just basic maths. The other part of the basic maths is the compounding capital growth and how returns compound over a long period of time. I've spoken about that a lot as well. Whereas with income, you've got to find another place to reinvest it and hopefully compound it. But if you're going to put it back into assets that are already giving you a high income, then it just compounds the tax drag. So what you really want is you want most of your return in capital growth up until the time you retire. And then the day you retire, you should sell all those assets, or not all of them, some of them, and invest it in more assets that have more liquidity, so that then you don't still need to worry about the split between income and capital growth. You can just worry about absolute return. So what is your total return? And if that means you're getting a lot of your total return still in capital growth, no big deal, because you've got these liquid assets like a ETF portfolio. You can sell $100,000 a year and live off the portfolio that way rather than necessarily income. So when you say your dilemma is capital efficiency, I'm going to challenge that, because what I would say is at your portfolio, have a look at your pre and post tax returns. So what is your pre-tax gross return? So that's your capital growth and rental yield after expenses. And so if you're getting strong capital growth, then that return's going to be, that total return's going to be somewhere between 7 to 10%. That's pretty good. And you put some leverage in it, you'll increase your return to maybe 12 or 13%. So that works, and that's going to do all the heavy lifting for you over the next 15 to 16 years until you want to retire. But if you look at absolute returns, so growth plus income, and it's not great, then that's when you've got a capital efficiency problem. And in that situation, you've got some underperforming assets. You need to identify those assets and potentially divest of them and then reinvest them elsewhere. But my gut feeling is that if you've got a lot of equity in an apartment that has, great position and it's getting a lot of capital growth, then I would probably say that your pre-tax return is strong and your post-tax return is strong too, because most of it's in capital growth and you've got some negative gearing in your portfolio. So imagine the return's fine and it will do the heavy lifting that you need it to do over the next 15 to 16 years. And then what you need to then think about, you want to have a transitional strategy on how you're going to introduce more liquidity into your investment portfolio. You might not need to do that straight away, because you might be able to sort of use super or whatever in order to complement income. But at some point, you probably want to start thinking about divesting property and then putting those monies, hopefully getting more money into super, maximizing the transfer balance cap, and then, but most importantly, have more liquidity in the portfolio. So thanks for the question, and I might leave it there today. Tomorrow's episode, I've spoken about previously a number of times in different episodes randomly that I reckon that there's only a handful of key decisions that you absolutely need to nail. These are fundamentally important decisions, and that's why I wrote the book Investopoly and rewrote it to Wealth by Design, to come up with a framework, a methodology, an operating system for making those key financial decisions. And on YouTube, someone asked me recently, what are those decisions? Well, that's what I'm going to talk about tomorrow. The 4 decisions that people make over their lifetime that probably determine 95% of their financial outcomes. So until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.